Good evening, ladies and gentlemen, and welcome to this first of our series of seminars, the spring series. We've finished with the politicians now, and it's back to the real world. And particularly this evening, a real-world problem for millions of people who, for one reason or another, do not have access to mainstream finance. They can't get overdrafts as we can. They can't get debit cards and credit cards as we can. They can't get car loans as we can, and so on. And that is a real issue for a number of people. Famously, 3 years ago, the Archbishop of Canterbury said that he was going to compete Wonga out of business by starting a lender of his own. And I'm afraid Wonga is still in business and charging up to 1,500% on short-term loans at a time when interest rates are at a record low level. So obviously the Archbishop of Canterbury meant that very sincerely, and I'm sure that he's done a lot of work on it, but it's not a problem which can be very easily solved. And it's against that background that about a year ago, the Carnegie UK Trust brought together a group of interested people from different directions to start to look at the problem and trying to put some dimensions on it and reach some conclusions. And that is the subject of our discussion this evening. And the form of that, we're going to have, first of all, a brief presentation from Douglas White of the Carnegie UK Trust of what is in the report that has been produced after that process, and then some contributions from a panel, which I shall chair, of people who took part in that group. Professor Jeremy Peat, you'll know, as my predecessor here, but now visiting professor at the University of Strathclyde. Sharon McPherson, who runs Scott Cash, who has, as it were, hands-on experience of dealing with this problem in Glasgow. Stephen Pearson from Virgin Money to give us a view from somebody in the mainstream finance industry. And then Sarah Davidson from the Scottish Government. I will ask them very briefly to give their response to the report. Then we'll open it for discussion and questions from you all. And then to wrap up the evening, the very Reverend John Chalmers, who is going to take this issue forward in an action group, will give his response at the end of the evening to the discussion that we've had. So I hope you enjoy the evening. There's some interesting and thought-provoking things to come, and I'll hand over now to Douglas White. Thank you.
Well, thank you all very much for joining us here on this fine evening to discuss how we can improve access to affordable credit for some of the most disadvantaged communities and citizens across Scotland. Particular thanks to Ray and all the team at David Hume Institute for hosting the seminar this evening. And I'm really looking forward to what I think will be a very stimulating and productive couple of hours of debate and discussion. My job for this evening is to give you some of the key findings from the final report of the Carnegie Affordable Credit Working Group, which was published a couple of weeks ago and sets the context for our deliberations tonight. Copies of the report are spread throughout the theatre, and please do take them away with you at the close of the session tonight. As many of you will be aware, the question of whether and how we can deliver more affordable credit for some of the poorest members of society has long been a highly complex and contested public policy issue, both in Scotland and across the UK. There are many people who would argue that those with the fewest resources shouldn't have the opportunity or the right to borrow money at all. That was not the position adopted by the Affordable Credit Working Group. Our view is that affordable loans, delivered appropriately, can play a significant role in improving people's quality of life and well-being, and can have a critical role in taking people on a path to greater financial inclusion. At the same time, however, the working group was very clear in its view that affordable loans can only be one part of a package in activity to improve greater financial equality. Loans are not a substitute for decent wages or decent welfare benefit payments. And given the often highly charged, emotive and complex issues around the provision of affordable credit, we were delighted in the working group to have the support of the Church of Scotland, in particular the Very Reverend John Chalmers, Principal Clerk to the Assembly of Church of Scotland, and his commitment to this work has given the process, we believe, a real moral authority. Because, whether we like it or not, people with the fewest resources in our society do borrow money on a regular basis and often have a compelling need to do so. But at present, the lending arrangements which are available for people are less than optimal. As Ray alluded to, many people can't borrow through the same channels that you or I have the opportunity to borrow money from when and as we need it. Barriers to mainstream loans that many people experience include a lack of or poor credit history, low income, and limited take-up of other financial products, including bank accounts. Instead, many people rely upon non-mainstream, high-cost credit alternatives, including payday loans online or on the high street, catalogues, home credit or doorstep lending, and pay a significant premium for accessing these credit products. This means that credit or loans are most expensive for those people who can least afford it to be so, compounding financial inequality. The high-cost non-mainstream credit sector in the UK is estimated to be worth around £5 billion a year, with 100,000 people in Glasgow alone estimated to make use of high-cost credit products. These issues have, of course, been a matter of debate and concern for public policy for many years. But there's been an increasing urgency around this debate in recent times. There was a significant growth in the high-cost non-mainstream credit market following the financial crisis in 2008 for a variety of reasons, partly including the tightened lending criteria introduced by many mainstream lenders in the wake of that crisis. This led to heightened public awareness and debate about the growth and the scale and the practices of many high-cost non-mainstream lenders, and a robust and rapid policy response from the Financial Conduct Authority, who have introduced a raft of new rules and regulations over the past couple of years to restrict the activities of high-cost lenders. These include new checks around affordability, creditworthiness, repayment and collection methods, and an interest rate cap. These changes are highly welcome and have brought many benefits to citizens and led to a major contraction in the non-mainstream high-cost credit market. Fewer high-cost credit products are now available, fewer people are eligible to make use of these products, and less money is now being lent. But welcome though these changes are, arguably they only address half the equation. Because unless more affordable alternative supply of credit are made available and scaled up, then there's a risk that many people will be increasingly forced to meet their borrowing needs elsewhere, potentially from illegal money lenders, possibly from friends and family who may be ill-placed to afford such financial requests. But while there are a great many challenges in this public policy debate, I also believe there's a great opportunity for Scotland to lead the way and find new solutions in how we can deal with these long-standing complex issues. There are lenders offering alternative loans to those excluded from mainstream finance on a not-for-profit basis at significantly cheaper rates than commercial non-mainstream high-cost lenders. Scotland is one of the best community finance sectors in Europe. There are over 100 credit unions and the award-winning CDFI ScotCash in Glasgow. Great though these providers are, they're currently minute in comparison to the commercial non-mainstream credit sector. The challenge, therefore, for public policy and practice is to grow our existing lenders to a scale where they can provide a real, viable alternative for people to borrow money from as and when they need it. And there's an excellent window of opportunity to do this in Scotland at the moment. We're seeing forthcoming changes to the welfare benefits system. The government's committed to a Fairer Scotland agenda. There's the work of existing organisations and initiatives such as the Scottish Financial Health Service. And the big lottery will shortly be making investments in social inclusion and debt activity in 5 local authority areas. The prize, if we can get this right, is great. Savings of potentially millions of pounds every year for those who most need it. But these issues cannot be addressed by one organisation or one sector alone. These are deep-rooted, highly complex and contested public policy questions. We need government, civil society, industry and the voluntary sector to work together to find the right solutions and find our way through these challenges, both nationally and locally. We need what some might call a mega community for affordable credit. It's in this context that we established the Carnegie Affordable Credit Working Group in May last year to look at how we might achieve change at scale on this issue in Scotland. The group was chaired by Jeremy Peat, who we'll be hearing from shortly, and Angus Hogg, chair of the Carnegie UK Trust. And we were delighted to have participation in the working group from all the different sectors that I just mentioned. From the world of finance, we had RBS, who've long been pioneers in this area, and Virgin Money. We had the key provider interests involved, the credit unions and the CDFIs. We had the advice sector, Step Change Scotland, Money Advice Scotland, and we've also been supported by Citizens Advice Scotland. We had funding input from the big lottery. Government has been involved at both national and local level, and a range of key civil society organisations, including the church, housing associations, and academia. And coming together, the working group set themselves this vision that they want the outputs that we've produced to achieve, and this outcome statement, that all citizens in Scotland, wherever they live, have access to excellent forms of community lending, which helps them to reduce the cost of borrowing and supports their financial inclusion, promotes fairness, and reduces inequality. The working group is very clear that in order to achieve this vision, we need to significantly grow Scotland's credit union and CDFI sectors so that these providers can reach many more people than they are currently able to do. The group is also, however, very clear that the growth of our community lending sector must be underpinned by 9 core principles, which can be briefly grouped into three broad categories. Firstly, and most importantly, affordable credit providers must deliver for the customer. They must deliver the services that those who borrow from them actually need and want. That means services must be affordable. People can afford their weekly or monthly repayments. They must be efficient. The cost to the customer must be minimised so that the interest rate payment is as low as possibly can be. They must deliver quickly, because that's a key ask for many people wanting to borrow in this market, but also fairly, recognising that loans are not the right solution for everyone and that responsible lending is critical. Loan products must be flexible. People may require to miss a payment if their finances are particularly tight in any given week or month. They must also be reliable, there for people through the channel they want when they need them. And socially motivated, delivered on a not-for-profit ethos. And of course, visible, actually out there so that people can see what's available to them and take up the services as and when they require them. As well as delivering for customers, the future of affordable credit services must also be financially sustainable, with a long-term future that doesn't require recourse to the public purse on a regular basis. It means it must be market acceptable, and I know Jeremy Peat is going to say more about this in his remarks that follow. Finally, and crucially, the working group was absolutely clear in its deliberations that as important as credit is itself, it is also must be seen as a gateway to wider financial inclusion. It must be a prism through which people have the opportunity to improve their overall financial position, through access to bank accounts, through support for debt advice, through income maximisation services, and help accessing the appropriate welfare benefits. Credit is important, and that's our starting point, but it must be a route through which people can achieve greater improved financial well-being. In order to deliver these principles and achieve the vision that the working group set out, the group identified 4 strategic challenges that we must overcome, and I want to say a little bit more about each of these. Firstly, if we want to achieve change on the scale that we require, we need to have a much better understanding of the customer base that uses the non-mainstream credit market at present and the motivations and issues that drive that. The public policy narrative often portrays the aim of moving people from one particular type of lender to another as relatively straightforward. We clearly have the desire to move people away from high-cost, non-mainstream credit providers, be it payday loans, home cost credit, or catalogues, towards more affordable community alternatives, credit unions or CDFIs. But actually, if we want to do that, we need to recognise that the customer groups that use these different types of loan products vary quite significantly. Different demographic makeups rely on different types of products, made up differences by gender, by age, by income, by employment status, by tenure, by geographic location. And unless we understand that actually the non-mainstream credit market, small as it is compared to the mainstream market, is actually very nuanced and complex, we won't be able to come up with the products and services that people want and need. Secondly, we need to recognise that delivering the types of credit that we're talking about here is inherently expensive. The vision of the Affordable Credit Group is to reduce the cost of credit to those most in need as much as possible and make these loans as cheap as possibly can be. But it is inherently expensive to deliver small, short-term loans to disadvantaged customer groups for a variety of reasons. Firstly, many customers that borrow in this market are excluded from mainstream financial services. They have a poor or limited credit history and therefore a higher risk of bad debt. And the cost of lending has to include this risk element in its calculations to ensure that it's sustainable in the longer term. Secondly, the type of loans we're speaking about are often sought quickly through a highly personalised customer service, both of which bring costs with them as well. And thirdly, short-term, small loans, often £500 to be repaid within a year, have the same very similar fixed lending costs to larger, longer-term loans and are therefore proportionally more expensive to deliver. And we need to recognise these issues if we actually want to advance the agenda and bring about change, while always seeking to make loans as cheap as possible. Thirdly, we need to recognise that those who borrow in the non-mainstream market don't necessarily have the same borrowing preferences as those accessing mainstream credit products. Of course, price is important for everyone, and making loans as efficient and as affordable as possible is key. But a range of other issues are also important for those excluded from mainstream financial products. Speed is often of particular significance in the ability to get a loan quickly, as is simplicity, a non-intrusive application process that people can understand and work through. Trust is a critical issue in this market. We're talking about many people who have had years of bad experiences of trying to access mainstream financial products. When they find a lender who's willing to loan them money, they're keen to maintain that relationship, and a high degree of trust between the lender and the borrower is critical. Closely related to that is the importance of customer service, the lender understanding people's circumstances and taking that into account when offering a loan. Flexibility, I mentioned, is also vital. The ability of a customer to miss a loan payment on a particular week or month within reason, if their financial circumstances require that in that time. And also the payment schedule that people experience. How much does the loan cost for me on a weekly or monthly basis is often more important than the overall price of that loan. Again, if we want to achieve change at scale, we have to recognise these preferences and issues that people want in their affordable credit products. And finally, we have to understand that the cost of lending within this market is affected by a whole range of different factors, and different providers will be able to offer loans at different rates depending on the makeup of these different issues. So that might be the loan term, how long the loan is for, and what the repayment frequency is. Is it fortnightly? Is it weekly? What's the value of the loan? How much is being lent? What's the volume of loans that the institution is giving out on a weekly, a monthly, an annual basis? What's the staff conversion ratio? How often do staff have to see a customer or a group of customers before a loan is made? What are the delivery channels? Is it face-to-face? Is it online? Is it telephone? What are the overheads? Is it staff, technology, premises? What's the risk appetite and the risk assessment process that a lending organisation goes through? What's the proportion of bad debt that the organisation is able and prepared to take account of? What's the cost of capital? How much does it cost to act for the lending organisation to actually bring in resources that it can lend out to people? All of these things affect the value of, or the price of the loan that either credit unions or CDFIs are able to offer. But again, we need to understand these nuances if we want to grow these sectors in a way that delivers at the scale we're talking about. This brings us on to the second strategic challenge identified by the working group. And that's if we want to grow our credit unions and our CDFIs, we need to properly understand the challenges and the opportunities that each of these sectors face if we want to help them grow and compete on a viable basis with commercial non-mainstream lenders. Credit unions, first of all, have a great many strengths in this area. They are by far the larger of the two affordable credit sectors, with over 100 operating across Scotland. They have ready access to loan capital that they can give out as in the form of loans to some of the groups we're talking about. Scottish credit unions hold over £450 million in savings from their members. Credit unions also make good use of volunteers to administer loans, which reduce the cost of lending and therefore can help them deliver loans on a cheaper basis. The Credit Union Expansion Project, currently being funded by the Department for Work and Pensions, is seeking to reduce the cost of lending further for credit unions, and a number of Scottish credit unions are taking part in that project. Credit unions have a trusted brand and have strong links into wider financial inclusion initiatives. And their rates are significantly cheaper than the commercial high-cost credit market, delivering loans within an interest rate cap of 3% a month. But credit unions also face challenges if they want to grow and deliver at the scale we're talking about. Although the credit unions hold millions of pounds in loans from their members, this capital is not always fully exploited, with over £100 million currently sitting in Scottish credit unions, which could be out on loan, delivering affordable credit to some of the most disadvantaged groups we're talking about. One of the reasons, of course, for this is that credit unions are member organisations. They take savings from their members, and they have to balance between making loans to potentially riskier client groups versus delivering a reasonable return for members who are saving money with them. And of course, I'm talking about credit unions as if they are a homogeneous group. We have 100 credit unions in Scotland. They are a very diverse sector. Some credit unions are interested in extending their lending models and reaching out to make more loans to disadvantaged consumers. Others, quite legitimately, are not interested in going on that journey and wouldn't necessarily have a part to play in growing affordable credit to the scale we're talking about. It's also not entirely clear whether the type of lending that we're talking about, small, short-term loans to highly disadvantaged groups, can be delivered at scale within the cap that credit unions currently operate in, unless they can cross-subsidise by making more loans available to more affluent members, and then cross-subsidising that to make more loans to disadvantaged groups. That's a business model that's being developed, but it's not yet fully tested. CDFIs, on the other hand, face a range of different opportunities and challenges. They have more flexibility in credit unions in the rates that they charge, which arguably gives them greater flexibility to reach out to provide the type of lending that we're talking about. CDFIs also have a more exclusive focus on disadvantaged communities, which means that they don't have to weigh up different interests in deciding who it is that they loan money to. Like credit unions, CDFIs also link into wider financial inclusion initiatives and seek to improve people's overall financial position, as well as in offering affordable credit. But CDFIs face their own challenges. They're usually more expensive. The loans that they offer are usually more expensive than those offered through credit unions, partly because of this focus on disadvantaged groups, which makes it more difficult for CDFIs to cross-subsidise between more affluent borrowers and those who are less well off, but also because CDFIs, unlike credit unions, don't have members who are saving money with them, which means that the capital that CDFIs need to access in order to make loans, they have to source from different markets. And of course, the price of paying for that capital has to be built in to the price of the lending that they offer. And this question of accessing investment is probably the key challenge that CDFIs face if they want to expand and grow to the scale that we want to see happen. Because it can be difficult for CDFIs to persuade commercial investors to back them and back their business model. This business model of small, short-term loans to highly disadvantaged customers is not one that is necessarily easy to persuade commercial lenders to invest in. It has been done and it can be done, but it's a challenge. Which brings us on to the third strategic challenge that the working group identified, and that is this question of investment. We need to bring new resources and investment to both credit unions and CDFIs if we want them to grow as we've described, to enable them to make more loans, to build their infrastructure, to recruit, train and retain staff, and to develop new technology which can reduce the cost of lending and expand their reach. Investment in both sectors has been delivered in the past by public, private and charitable sources, including DWP, Royal Bank of Scotland and Big Lottery, amongst others. But sustainable financial models are required for both. For credit unions, primarily this is likely to mean new members. New members can be the route to new funds. More people to save money, more people that might take out a longer term, larger loan, which can then be used to cross-subsidise the types of lending that we're talking about here. For CDFIs, the challenges are different. It's about bringing in that external capital. Public funding has a vital role to play, particularly in the start-up phase for CDFIs, and Sharon from Scott Cash may say a bit about this in her remarks. But in the longer term, CDFIs need to be financially sustainable, and having that investment from the public purse can actually be off-putting to commercial investors who want to see a sustainable business. Brokerage between CDFIs and financial investors is key. Personal lending CDFIs are quite an unusual beast. They work with a customer group who are highly disadvantaged and excluded from mainstream lending. There is often public support for the business model. They are offering financial inclusion support as well as loans, and that has to be priced into their lending. There are a limited number of comparators for investors to look at to make a judgment about, and there is diversity across the sector, which makes it difficult for investors to compare like with like. So CDFIs need some help to codify their models and to build relationships with financial investors if we want them to grow and achieve what we know they can achieve. The final strategic challenge identified by the working group is the question of partnerships. So how do we turn the mega community that we identified at strategy level into practice on the ground at grassroots level? Great examples exist across Scotland and across the UK of credit unions and CDFIs working in partnership with local institutions to deliver change and to deliver affordable credit. The question is, how do we make more of these things happen, and how do we make them happen at scale? Some examples of what those partnerships might be would include referrals from any organisation with an interest in social justice to an affordable credit provider, be it from advice agencies, housing associations, churches, libraries, charities, or health and social work. Alternatively, these providers might make their premises available to affordable credit providers so that they can offer loans at a more affordable rate. Financial services also have a critical role to play in partnering with our credit unions and CDFIs. This might be in partnering between referring people for a basic bank account, which we know has happened, and Scott Cash has a model that works in that regard. So people are referred from a community lender to a mainstream lender in order to get access to a bank account, beginning their progression to financial inclusion. Or it might work the other way. If individuals are turned down from a loan from a mainstream lender, can that mainstream lender refer people to their local affordable credit provider to see if they might be able to help? Again, examples of that exist, but it's how we make them more commonplace. And all of this exists within the idea that affordable credit must be a route to wider financial inclusion, and that there are a range of partners that can get involved in this issue to deliver to help people access not just affordable loans, but also to access bank accounts, debt advice, income maximisation, benefits advice, and budgeting support. How then do we get there? The working group set out 18 recommendations of things that we can and should be done in order to achieve the outcome statement I described earlier. These 18 recommendations are split across 4 activity areas: leadership, development and investment, partnerships, and insight. And I'll say just a little bit about each of these. On leadership, we recognise the excellent work already going on at national and local level in Scotland in terms of driving forward activity on making access to affordable credit available to more people. But we need to raise the profile and the status of affordable credit in public policy if we are to achieve the change at scale that we set out as an objective in the report. To that end, the working group has recommended the establishment of an affordable credit action group to lead activity and strategy on this issue over the coming months. And we're delighted that John Chalmers has agreed to chair and convene that working group, and the Scottish Government has also agreed to participate in the activities of the group. We need continued leadership from elected members nationally and locally to champion the importance of affordable credit as a key public policy issue and its contribution to social justice. On development and investment, what we've tried to draw out through the work of the working group is that this is a complex, detailed and challenging area. And we think that some extra capacity is needed to help affordable credit lenders address some of the technical challenges that we've identified can act as barriers to them growing and delivering at scale. Credit unions and CDFIs need help in building relations with financial services, in sharing best practice to identify how the most effective solutions can be deployed more widely, in helping local areas find the right affordable credit solutions for them so that they can pick the model that best suits their local needs, and in costing out solutions so that we know how we can deliver change at a local level, but doing that across Scotland. As well as that technical support, we need development and investment support from a range of other players. Employers have a critical role to play in partnering with credit unions to allow savings and loans to be deducted from payroll. For CDFIs, we need more focus from trusts, foundations and social investors who can offer innovative forms of investment to CDFIs to allow CDFIs to demonstrate their business model to the commercial investment sector. On partnerships, what can we do to build the mega community? We need better partnerships, as I described, between the community lending sector and the mainstream finance sector, referrals working either way. We need better relationships between community lenders and credit reference agencies. Credit reference agencies, we've asked in the report to waive or reduce the fees that they charge when community lenders submit credit files to them, so that those who borrow from a credit union or CDFI can use that loan to build up their credit history and therefore access more mainstream products in the future. We also need increased partnership working between different community lenders to share best practice and to build a sense of shared purpose. And we need new local partnerships to drive forward activity at local level between all organisations with an interest in tackling social justice, of which affordable credit has a vital role to play. Finally, we have a series of recommendations around insight. We need to keep learning and understanding this market. These are challenges that have existed for many years, and we can't hope to solve them overnight. We need to keep researching and keep understanding what more we need to do and what we can do better. For example, we recommend better measurement of affordable credit in national and local performance frameworks, such as Scotland Performs or in single outcome agreements, to raise the status and profile attached to affordable credit and make sure we're assessing how we can measure change. We also need more research on the impact of the recent Financial Conduct Authority regulations to understand where people are now going to borrow money and what impact that might have on the community lending sector. And when it's laid out like that, a visual executive summary of the points in the report, it looks reasonably straightforward. I'm going to finish there. Thank you very much for your time, and I really look forward to the debate and discussion that follows. Thank you.
Thank you very much, Douglas, for taking us through the report. There's a lot in it, but it's very easy to read. It's written in a very accessible way, so I recommend it to you. But we're going to have some contributions from people who took part in the working group over the last year. I'm going to start with Jeremy P.
Well, thank you, Ray, and may I first of all thank Carnegie for allowing us to do this work. I mean, it's a great pleasure for me to work with such an efficient and quality organisation, and thank you all for the input you provided. I first came across this issue when I was a member of a Church of Scotland working group on the purposes of economic activity, which was a good title. And I became very clear about the issues, but without becoming clear about the solutions. So when Martin Evans asked me to get involved again in a more detailed and very well organized assessment, I was only too pleased. Now, I am by nature a very impatient person, and I had to be persuaded that we couldn't move from this group to suddenly changing the world in one or two strides. This is a very complex area, and the issue in itself is hugely important. Affordable credit matters to so many people, and unless we get this right, we will not work towards dealing with social and economic inequalities, and it matters to many people. So I'm very pleased that we are taking it step by step and moving forward, and delighted that John Chalmers has agreed to lead further, and we will have the very close involvement in that next steps of the public sector, delighted Sarah's with us today, and of the financial sector, hence Stephen, and we'll learn from the experience of what has been going on. I just want to focus on a couple of key points. One is this question of a sustainable model that Douglas kindly said I would pick up. Gosh, it's difficult, but I think I want to emphasize there are two stages in establishing a successful community development finance institution. The first is when it gets up and running, proves it can do it, learns how to do it, but all the time having access to soft funding and support from a variety of sources. Now that's fine for the instigation period and for the first several years it gets up and running. But what we decided, we learnt from Sharon at Scott Cash and from the people at Moneyline south of the border, is that you have to all the time be working in the knowledge that when you are up and running in a fully proper way, you have to have a sustainable model. And you have to demonstrate to those who help to finance from the beginning that there is scope for getting to that fully sustainable model further down the track. And it's not a never-ending track, it's one with a reasonable time limit. And both Moneyline and Scott Cash have demonstrated that it is achievable, despite the fact, as Douglas emphasized, that lending money to this group is inherently expensive. Lending small sums at very short notice to people with no credit history is not a good business model, but it's necessary, and the existing CDFIs have proved that it can work, but only if you're incredibly well organized and incredibly good at what you're doing, and you have patient people helping you in the build-up phase. But I emphasize again, you must always be working towards the stage where it is wholly financially sustainable. This is not a long-term subsidized finance business. You may get volunteers involved, you may get help with premises on a continuing basis, but you have to demonstrate that you can be and will be and are becoming fully financially viable. And only then will you get the likes of the financial institutions to provide commercial money, which is the only way in which you can be sustained. So that's the first point. The second point I want to make is that it's not just about building CDFIs and letting people have access to these sums on a continuing basis. You have to aim at progression. People have to progress. They have to move some people towards credit unions. Credit unions are marvelous organizations. They're perfect for a number of people, but they're not perfect for a lot of people because they haven't been saving. They haven't got the right access points. They haven't got the right employment attributes to get into the credit union. But if they can move into the credit unions, that's tremendous. They'll get cheaper money. They'll get a more sustainable financial model for themselves. We hope they can move to basic bank accounts. And so part of the process at these CDFIs and others is to provide financial advice to individuals and families so they learn how best to manage their finances and how they can become part of the mainstream financial community. That's got to be part of what you're trying to achieve. And it can be done, and it has been done. So get financially sustainable, work towards progression, and accept it takes time. But by golly, it matters, and by golly, it can be done. Thank you.
Very good. Thank you, Jeremy. Now, the Scottish Government was part of our group and came on that terrible phrase, but learning journey with us. And Sarah Davidson is here from the Scottish Government, so let's hear from the government view.
Thank you, Ray. As you'll see, my title is Director General for Communities at the Scottish Government. It's maybe worth just unpacking at the outset a little bit of what my interests are in this particular issue. I've got a lead across the Scottish Government on tackling inequalities and poverty and the pursuit of social justice. And I've also got responsibility for social enterprise and for credit unions operating in the third sector. And linked in some respects to this, as Douglas indicated earlier, I've also got responsibility for the policy and delivery of the new social security powers coming to Scotland. So a number of issues to which this is very, very pertinent. When Martin Evans and Carnegie colleagues first brought their think piece on this issue to me a year or so ago, two things in particular really struck me. The first, and again we've heard about it tonight, was the insights into the needs and perspectives of those looking for non-traditional credit. And I'm sure I'm not the only policymaker who has their assumptions and perceptions challenged by what the report has found in that respect. If we don't start the policy process there, i.e. with the needs of those who are the potential customers, then what hope have we of designing a good response? And that resonated with work which we were doing across government, in part inspired by the possibilities of digital technology, to think of service design, thinking there of public services, which much more are designed around the needs of individuals rather than the needs of the organisation providing the service. And the second insight which really struck me was the analysis of the costs of delivery of short-term, relatively small loans. And again, Douglas outlined that earlier. And the challenge to taking an APR-centric view as a starting point. And in doing so, for me, Carnegie were taking this discussion from the realms of rhetoric and principles to something that's held out the promise of a valuable, challenging, and essentially practical manifesto for action. And as Ray's indicated, on the basis of that and the confidence which we had in the work that Carnegie had convened in the past, we were happy to make a senior colleague available to join the working group. And it was no surprise for me at all to see that the final report did deliver on developing the analysis around both of those insights and more. It kept the focus in on keeping the individual's needs front and centre, but didn't shy away at all from the difficulties that are posed for organisations and institutions in designing and resourcing a model which meets those needs. And we've just heard a bit more about that just now. The formal Scottish Government position, insofar as I'm here to represent that tonight, is to welcome and to endorse the findings of the report, which we see as a strong basis for determining action at the next stage. We will, as Douglas has said, take part in the proposed action group, and subject to the outcome of the forthcoming election, I would anticipate that an incoming administration would see this issue as part of any suite of actions to contribute to achieving social justice. For I'm absolutely clear that it's in that broad policy territory that we need to consider this topic. The current government's vision for social justice is of a country where by 2030 people are healthier, happier, treated with respect, and where opportunities, wealth and power are spread more equally. Our recent Fairer Scotland discussion with people across Scotland about what mattered to them, including in the context of social security delivery, underscored the importance of a relational approach, embracing dignity, trust and respect. And it's therefore no surprise at all to see those themes recurring again in the list of things which matter to those seeking non-traditional credit. Many people here will know that the Scottish Government has done quite a bit of work recently in relation to credit unions, and the report of the Ministerial Credit Union Working Group was also published earlier this year. The key themes for action which emerged from that were payroll deduction schemes and financial education, including junior saving schemes run by credit unions in partnership with schools. And as government, we've already made some commitments in relation to the recommendations in that report, including just last week announcing funding for credit unions to set up junior saver schemes in schools across the country. All of the recommendations in that report appear to me to be entirely consistent with enabling the environment for credit unions to flourish in line with the aspirations expressed in the Carnegie report. But nonetheless, I hear very clearly the challenge in the report we're discussing tonight to significantly up our collective game on access to affordable credit. It's a fair challenge, implicit in the report, that financial inclusion has maybe not had as coherent and obvious an organisational place in the Scottish Government to date as it might have had, although at ministerial level successive ministers have been strongly supportive of and have taken a close personal interest in this issue. And that's something that we'll be looking at in the light of the report and in the wider context of thinking how we coordinate and organise our work on social justice. I'm also very interested in the practical detailed partnership model illustrated at the start of Chapter 6 and again which Douglas set out for us a few moments ago. As with much of the social justice agenda, the challenge which is posed for all potential partners there is ultimately what kind of a society do you want to see in Scotland and what part are you prepared to play in bringing that about? as is helpfully set out in the model and indeed represented in the panel here tonight, that's not a question only for national and local government, although we have an important part to play, but also for wider civil society, for financial services, for existing community lenders, and for trusts and for foundations to address. And that's why I'm particularly pleased to be part of the discussion here tonight.
Good. Thank you very much for that, Sarah. Now let's hear from people who actually do lend money and have experience in this market. First of all, Sharon, if we could come to you. Sharon runs Scott Cash, which is actually a lender in Glasgow. So, Sharon, what's your perspective on this?
Thank you. We were very excited to be part of the working group established by the Carnegie Trust, and commend the Carnegie Trust for the report and the fact that they've highlighted financial exclusion as such a key issue in relation to the poverty agenda. We were excited because even though financial services are much more accessible than they've ever been, there are groups of people for whom exclusion remains stubbornly persistent. And it's generally those groups who are on low incomes and have few assets that experience the highest levels of exclusion. And exclusion matters because it hurts individuals, it disrupts families, and it affects local communities. And it makes living on a low income much more stressful and expensive than it otherwise would be, and obviously marginalises people and acts as a barrier to their own personal development and their inclusion in society and their economic progress. And that's why we think that the report, the Gateway to Affordable Credit, is so important, because there are millions of people who are living on low incomes, as we've heard, that are unable to access mainstream credit and end up turning to very expensive subprime lenders. And it's the cost of servicing that debt that impacts on poverty and makes it much more difficult for individuals to manage their money on a daily basis. And there are lots of examples in the report of high-cost credit, and I think it's always worth restating what that actually means. If you look to borrow £500 from a high-cost lender, a subprime lender, a very well-known one, you will end up paying back £910, and that's £410 in interest alone for low-income families. That, for a lone parent with 2 children, represents 6 weeks' worth of their total income. So that is the cost of credit for many of our customers. And I'm sure that many people in this room would never consider borrowing at those particular rates. And we know from our work in Glasgow that around £20 million a year is being paid in the form of interest payments by our citizens to high-cost lenders. And that if only 10% of those people were to switch to more affordable alternatives, there would be savings of nearly £1.8 million. We think that the report has successfully demonstrated the different models of provision through credit unions and CDFIs and brought out the challenges very, very broadly for both of those organisations. I think it's important to understand that in order to deal with this issue, we need a mixed economy of provision. We need credit unions and we need CDFIs. Given the cost of delivering such small sum lending, it's no wonder that we don't have a coherent sector that's able to deal with that demand. We are currently working on a very innovative pilot with the Cabinet Office to promote access to affordable lending from both credit unions and CDFIs through an online web portal. And that demonstrates the potential that we have as a sector to come together to avoid consumer confusion and to make sure that we're able to promote community finance in a rounded way. And we all have a part to play in supporting the recommendations within the report. And we know that from our experience in Scott Cash that the 4 areas of activity that have been outlined have helped us to meet the demand in Glasgow and develop a model that is very successful at tackling the poverty premium. We know that the Financial Inclusion Task Force was very successful in having banking exclusion and led the way on free-to-use ATMs, but it's a real need for strategic leadership in Scotland that is necessary to help us develop coherent expectations in terms of what we want to see on the ground and measure progress against these. We've been in operation for 9 years, and in that time we've learnt some very valuable lessons, the key one of which is around partnerships And partnerships are critical for the success of our model and helping address the multiple needs of our customers. Very rarely does a customer approach us with just a need to borrow. And in terms of the other services that we provide, we're able to access bank accounts for our customers, and we're being able to do that in such a way that takes away the fear for them in approaching mainstream banks or building societies. So we can help open accounts, and we can help people effectively operate those accounts to avoid bank charges and so on. Providing access to fuel advice and warm home discounts has proved enormously popular for our customers and very helpful in terms of making sure that they stay warmer in winter than they otherwise would do. And making sure that individuals get the right advice at the right time is hugely important to break that cycle of debt. So if we're approached for borrowing and that situation is unsustainable in terms of existing debt, we're able to parachute in money advice so that the individual gets the advice that they need instead of unsustainable borrowing. And promoting a savings ethos to help our customers with financial resilience is equally important. And we have a number of partnerships across the city with credit unions that allow us to open up their savings accounts for our customers. And we hope that that helps our customers then move on to credit unions, which, as we've already heard, is cheaper than CDFIs. So for Scott Cash, it's that integrated service delivery that is the most successful aspect of our organisation. And the benefits can be really significant for our customers and for local economies. We have not yet developed into or matured into a fully sustainable model, but we do have a business plan that will allow us to reach that in the next few years. But if it hadn't have been for that initial investment from Glasgow City Council, Communities Scotland at the time, and various housing associations, we wouldn't have been able to set up the organisation to meet the demand. And we've already demonstrated that the model works. We've done 15,000 loans for over £8 million, saving on average £5 million in interest payments, like-for-like interest payments. We've been able to open up 2,700 basic bank accounts in partnership with the Royal Bank of Scotland, Barclays, and more recently with Virgin Money. So that model works. We've opened up 700 savings accounts with credit unions, and our customers really value that integrated model of support. I think it's fair to say that Scott Cash is a very small organisation, and if we can save £5 million in like-for-like interest, imagine what can be achieved across Scotland. So our call really is for everybody in this room to think about how they can support the recommendations in the report and how they can help our communities get a better deal.
Very good. Thank you very much for that, Sharon. Now, Stephen, Virgin Money is a mainstream lender, so why are you interested in this market?
I have to start with a confession, actually, seeing as we have the Reverend Chalmers here. When I was first asked to participate in this working group, I wasn't very excited about it. I thought it fell into what I would call dull but worthy category. And the very first conference call we had did nothing to change my views. There were 20 people, I think I knew one of them, all talking over each other, anonymous voices on the phone. It was extremely difficult to think that this was going to be a meaningful and productive exercise. However, I persevered, and things changed when I went to my first face-to-face meeting at Carnegie House in Dunfermline. I met my fellow members, and it all began to make sense. I actually started to get quite excited about the project at that stage. Why was that? Well, there are three reasons. Firstly, I read the excellent materials produced by Douglas and his colleagues at Carnegie, and if you read the report, you will see what I mean. I was quite shocked by some of the statistics I read there. 940,000 households in Scotland living in relative poverty. 2 million people in the UK with no bank account. And by a rough guess, that could be 100,000 in Scotland. A 5 billion commercial credit market at high cost to consumer, 5 billion. And at the same time, a 54% reduction in payday loans being given out between 2013 and 14 because of the cap in interest rates. So it became very clear to me that this was a huge problem in our society. And the Carnegie working group was a chance to do something positive about it. So at that point, I decided to roll up my sleeves and join in properly. I actually went to visit Sharon at Scott Cash because I was quite impressed. As you've heard tonight, she knows what she's talking about, and it really brought both the problem and the potential solution to life. The second reason that I became excited was that as a challenger bank, our executive team had previously scratched our heads about how we could do something better for consumers than the payday lenders, but still on a working commercial basis. We never managed to solve that conundrum, and it kept getting put to the bottom of the pile. But I realized that through this initiative with Carnegie, the answer might be to work collaboratively with other players in the field who had the same aim. And there they all were, round the table at Carnegie. The third reason was that as a business that claims to be socially responsible, and as a bank, this was exactly the type of project where we had the potential to make real difference for good. I wanted to explore how the banking sector could do its bit to help the financially excluded. After all, helping customers onto the banking ladder by opening basic bank accounts was part of the package of help provided by lenders like Scott Cash, as we've heard. But of the big banks in the retail market, only RBS stood out above the others as fully committed to this sector. Indeed, they had been instrumental in setting up Scott Cash. However, I learned that many of Scott Cash's customers find us banks too intimidating and off-putting, to the point where even when Scott Cash made appointments for them to go to their bank and open a bank account, the customers didn't turn up repeatedly. So I realized that not only did customers need a choice of basic bank account providers, they needed a more user-friendly approach to be taken by the banks that would take the bank account to them and not the other way around. And against that backdrop, I'm delighted to say that as a direct consequence of this project, from tomorrow, as it happens, Virgin Money is entering a collaboration with Scott Cash in Glasgow, under which our staff will attend surgeries at Scott Cash's offices to help their customers open basic bank accounts. It's a very small step, let's be honest, but small steps can still be significant. A bigger step would be for a range of stakeholders, including banks, to support the extension of this model in other Scottish cities. Why do we only have a Scott Cash in Glasgow? Wouldn't it be great to have consumer finance lenders like Scott Cash working alongside the banks and the credit unions in every single major city in Scotland? I hope that this excellent report by Carnegie will be the start of that journey.
Very good. Thank you, Stephen, and thank you to all members of the panel. Now it's your opportunity to have your say, ask questions, make points. Could you please indicate, before you do so, who you are, and if you're speaking for an organization, then that organization. I'd like to say that we have roving microphones, but I don't see any at the moment. So for the time being, I will ask you to speak up, but who wants to go first, please? Yes. Microphones have just arrived, so in the center, please.
Thank you very much, Robbie Mockery, Heriot-Watt University, Association of British Credit Unions Limited for Scottish University Credit Union. I all have a quite different take, I think, on what's going on to what the Carnegie report. Partly because of work which I did last year with credit unions, which definitely identified some of the things which come out of the Scottish Government report as being important, payroll deduction. But I think that where I differ perhaps most profoundly are on two issues, much of which has to do with regulation. And one of the things which I think is difficult when you're doing a report from social finance is actually thinking about the links to regulation, which in this area turned out to be very important. It seems to me that credit unions in Scotland, social finance in Scotland, one of the big challenges will actually be encouraging entry. For example, Perth and Kinross Credit Union went through all the processes for registration. The Financial Conduct Authority is required to give a reply to them within 1 year telling them whether they will be able to operate or not. They got the reply on day 364. Now, for that year, they had managers in place, they had premises let, but they couldn't accept any money, they couldn't lend any money. So very substantial costs being imposed on them that way. I think that this actually reflects a larger issue, which is that the regulators, and this is a UK issue rather than a Scottish issue, I'm aware, the regulators are concerned about the capacity of social finance or institutions to operate on a sustainable basis. And so they are deliberately making entry difficult. Now, one of the reasons I think that this is important, if you look at countries in which credit union systems have become very effective, then typically they've reached a density of about one credit union per 20,000 people, maybe one credit union per 15,000 people. In Scotland, we're at 1 to 50,000, and there's a huge concentration in the west of Scotland. Edinburgh is effectively, well, accepting capital, and there is a credit union in Leith. Otherwise, Edinburgh is a credit union desert. So actually what we are looking at, I think there's a major difficulty about how we actually encourage entry. Yeah. I can keep going on, I'm sorry, but...
It's an interesting and it's a fair question on regulation, but regulation is a reserved rather than a devolved issue. But am I right in thinking that it wouldn't affect a CDFI because credit unions are deposit takers and are therefore regulated by the FCA and the Prudential Regulation Authority, but how are you regulated, Sharon?
So we're regulated by FCA also, and had to make that change from the OFT regulatory framework to the new FCA, and that wasn't without challenges. It resulted in huge resources in our organisation dedicated to that specific area. I'm pleased to say we now have full authorisation, but certainly we would have liked to see more proportionality in relation to the FCA regime, but we have successfully made it through the other side.
It's a reserved issue, Sarah, but it's something you can do by representation.
Yes, I mean, I think it's a really interesting set of issues that Robbie raises, and I think you've been just talking to some of my colleagues about the issues in the context of our credit union work. Clearly, Scottish ministers can always seek to influence UK government and its associated bodies on regulatory issues. You know, we could take a view on the scope for success in that, but I think the point particularly where individual institutions are or potential institutions are investing in getting themselves ready to get to market and then are delayed to that extent from doing so, I think that's an issue that Scottish ministers would be very concerned about and would want to make representations on. Yeah, good, thank you. Other questions? Yes, there's one here, please. Joe and...
Joe Elliott, I'm a trustee of the David Hume Institute. I wonder if there's anything that we can learn from the subprime lenders who are already successful in this market. I mean, what it's interesting that we're doing is rather than seeking to change the market by regulation or such regulation as there has been in effect rather ineffective because it's effectively choked off a great deal of the supply. But nonetheless, you know, these people must be doing something right because they've got the market, and you know, one of the things that's come out is that you know, it's a complex package of things which is being delivered. You know, the important thing is not just price; it's access to advice and so forth. And the payday lenders are somehow cracking this. So I'm just there's a wheel there that we're actually busy reinventing. I'd like your comments on that.
Sharon, can you learn anything from Wonga or not?
Absolutely. We can learn lots from subprime market, and we employ a number of strategies that are employed by the subprime lenders. For example, and Douglas referred to it in his introduction, we allow payment holidays where customers may face fluctuations in their income, and like lots of home collected credit providers, they allow their customers to have a payment holiday without any penalties. So we have taken that as a key element of our service, and it's one that's extremely successful and keeps our arrears level down and keeps our customers loyal to us. In terms of payday lending, there's a whole range of things there that people really value, speed and efficiency from which they can get the loan. And certainly we think that online presence is extremely important to replicate. Unfortunately, we're not as big as Wonga, and we certainly don't have the R&D budget of Wonga or the marketing budget of Wonga. So it's quite difficult for small, both CDFIs and credit unions, to emulate that online presence without a significant amount of investment in financial technology. So it's important that as a sector we try and address that. Obviously the DWP expansion programme's looking to do some of that, but in terms of investment, that's really where we need to build the sector so that we can take advantage of what we know from subprime.
Stephen, you've got the technology. Is there anything you can do?
Technology, it's hugely difficult. In fact, we had to build as a new challenger bank. We had to build our own current account, which took about 4 years, and we wisely started with a basic bank account because it has less complicated functionality, and actually because of that it's a good thing for consumers because, for example, there's no overdraft facility. I am aware that one of the payday lenders has recently taken to market in Poland a product called Happy, H-A-P-I, which has been built by one of the global technology giants, and it allows that online functionality for payday loans in a way that I think is very interesting, and I think it would be a big step forward if we could have some Scottish credit unions and CDFIs speaking to people like that to see if we can roll out that sort of technology.
It's a good lead, thank you. And a question here, please.
Okay, my name's Alistair Grimes, and I'm the chair of Responsible Finance, which is the trade association for the 50-odd CDFIs in the UK. I want to make 3 quick observations around what's been said and a couple of observations about the report, that's okay. First of all, just to Jeremy's point, I mean, if you want sustainability, finance is a volume business. That's the only way you make finance sustainable is by doing it at volume. And that's actually the lesson from the payday lenders. And therefore, my question is, if you have lots of small agencies, will you ever get to sustainability for most of them? The answer is no. So there has to be something around volume about that, and that comes back to the point about not just more Scot Cashes, but actually bigger Scot Cashes. And within that is the issue of cost. Interestingly, there's a CDFI in the north of England called 5 Lamps, which is doing quite a lot of stuff around IT and internet-enabled banking. But volume is the key to this. The second one is just to pick up Sarah's point, I think, which is, I think the Scottish Government, by focusing on making Scotland a credit union nation, in a sense, is missing the issue. What we need to look at is responsible finance. Because the danger is, if you put it into that credit union space, you get agency capture, which is you look at the problems that credit unions can solve. And as we've heard from the report, these are not the problems for high-cost, small amount lending by and large. So I think the Scottish Government needs to widen the debate out beyond credit unions to responsible finance. And I think a couple of other points I quickly want to make. One is, I think there is a challenge around affordable credit, which is what do we mean by affordable credit? And the sad truth of the matter is politicians have a very different view about what's affordable. And I know Glasgow were actually very brave, in a sense, to back Scot Cash, because other local authorities have backed off saying, this is just too expensive. Whereas the customer's view of what's affordable is not that of politicians. So we need to do something there around the inhibiting dead hand of political debate around this, if we actually want to do something which is around affordable in a sense that customers understand it. And my final point, I think, is whatever you do, don't put any of this into the framework around measuring whether it's part of the national whatevers. I think this will just kill it stone dead, and it will turn it into a measuring, a numerical exercise, and it will ignore actually everything you need to do on the ground to make it work. I think that way perdition lies.
Jeremy, do you want to respond to this point?
Yes, I mean, I don't actually disagree with anything you've said. First of all, on the question of volume, you're absolutely right. We can't have a credit union, a CDFI for Leith or for Pennycook. And one of the interesting developments we learnt about in this working group was that 3 local authorities in central Scotland have been looking together at establishing a potential CDFI in order to gain the scale that might be sufficient to make it financially viable. Now, I think that makes sense. I think that if Edinburgh and the Lothians would be of a scale where that could happen. But don't expect there can be one in every small corner. It's not the answer. And it may be that actually when you come to rural areas, the model may not at this stage be viable. And you have to accept there are limitations. But I think for Dundee, Aberdeen, Edinburgh, central belt areas, there are geographical areas of concentrated population with deprived communities looking for finance where the scale makes it manageable. It's very, very tough and very, very tight. And that takes me to your third point, which is affordability. It won't ever be cheap. And you're absolutely right that politicians, and this applies to local authority politicians as well as central government politicians, have to be prepared to accept that individuals themselves are prepared to pay a fair amount of money for this credit, provided that they're paying it to an institution that's not ripping them off, but providing them what they want, which is small amounts at short notice with a degree of flexibility of repayment and without the credit history that goes to getting in. So you've got to accept that, and you can't be put off by the fact this is going to cost more than the 3% per month credit union cap. It will cost more, but the individuals who want the credit are prepared to pay it, and provided the institution is well established, working efficiently, working to these wider goods, fine. And then on your last point, which was the middle point about responsible finance, yes, I mean, I think what we're saying is that there is no one solution to this. Credit unions are marvellous institutions, and I think the tale that Robbie told is a dreadful story, that it takes 364 days and the poor folk are sitting there waiting. More credit unions, fine. Credit unions spreading their wings to being slightly different types of institutions, being flexible at the edges, great. But they don't provide everything. Credit unions plus CDFIs plus basic bank accounts plus good financial advice begins to get you there. But the whole question is responsible finance to provide affordable credit. It can be done, but you've got to be prepared to accept it's expensive, and you've got to be prepared to be blooming efficient, as Sharon has demonstrated is really achievable.
Good. Sarah.
Just very briefly, on the point about widening debate beyond credit unions, absolutely. And I think when I say that we accept the analysis in the report, that's indicating that there's much more work to be done there. I just wanted to pick up on the measuring point. When I think about measurement in this context, it's thinking about what are the indicators that we would want to see in a number of years that indicated that we were making progress towards better financial inclusion in Scotland or better social justice in Scotland. And it would be an interesting question to say, how many people being able to access affordable credit, for example, would be the kind of indicator that we would want to see. And I think that kind of measurement is helpful. But I absolutely accept that if you focus on the measurement at the expense of actually achieving the outcome, then, yeah, road to perdition.
Very good. Neil, and
yes.
then Bunmai.
Hi, my name is Neil Alexander. I'm a freelance consultant. I work in the field of affordable credit. I'm a former employee of Moneyline, who Jeremy was very kindly mentioning. I was a development director at Moneyline, the largest personal lending CDFI in the country. I make a couple of comments if I could. One probably supports what both Alistair and Jeremy have said. I commend the report. I was involved in the working group. I am absolutely delighted that someone of the stature of John Chalmers is involved to make the moral case on APR, something many people in this room have been going on about for many years, that price matters, but it is not the most important thing that matters to the customer, and there is a hugely different issue between price and cost. The fact of the matter is, if we're trying to minimise the cost to the customer and not maximise it, then sometimes APRs will sound expensive, and it's important that government and commentators and politicians make the case that that sometimes is the price that it has to be. there is a real danger borne out nationally just now that those on the lowest incomes who are arguably being served just now by payday, although they're not, who are arguably also being served by home credit, although they're not, are about to be completely underserved by those markets. I'm going to give you quickly 4 numbers. In 2012, Provident Financial, the largest home credit company in the UK, had 1.8 million customers. I spoke to Provident today. I'm quite closely connected with Provident. They have fewer than 1 million customers now in the home credit market. They've slashed their numbers by half. Guess who the half are who are not being served by Provident anymore? Now, we can argue whether paying £82 per 100 is a good thing or a bad thing, but the people who have lost out from Provident just now are the lowest income quintile, the lowest income. That's who's missing. They're missing because politicians have decided that a flexible payment method that Sharon advocated, and she's absolutely right to advocate it, I'm a big fan of Scott Cash, pay, miss, which is what Provident's model was for the last 125 years, is now being advocated by people who have never borrowed money in their lives on the doorstep, is no longer seen as being flexible, it's now seen as being unaffordable, and it's about flexibility rather than affordability. So my comment is, APRs are the misnomer in the room that I'm absolutely delighted that John Chalmers is involved in taking the moral authority lead on, and that if we don't recognise that there is a greater need for a wider range of social finance provision, then those on the lowest incomes who need credit, and we can all argue whether credit is a good thing or a bad thing, I put my hand up to it being a good thing, those on the lowest incomes will miss out completely unless there are more organisations who are prepared to find the price that minimises the cost and doesn't maximise it.
Very good. Thank you, Neil. I'm going to let John answer that question in a moment, but I'm going to come now to... Sorry. Another
My
question.
name is Ruth O'Reilly. I'm just here in a personal capacity, and I'm interested in the views of the panel on what is the best approach whenever loans do go wrong. Do you have a sense of what can be done to protect struggling borrowers from having their credit rating diminished in some sense, while at the same time not disincentivizing the lenders themselves from a borrowing or a lending regime in the first place?
Sounds like you, Sharon, I think.
I think that the first point to make is that prevention's better than cure. And where we lend to an individual, we don't just look at their financial circumstances at that point in time. Because of our customer demographic, we look well in advance in terms of welfare reform, for example. Are they expecting to get their disability payments for the next year? Will their income dip as a result of changes in their family household makeup and that sort of thing? So those approaches have stood us very much in good stead. But where there are financial difficulties, and of course you can't legislate for that, forbearance is really important in terms of supporting the customer through that difficult time. And we deal with all bad debts in-house predominantly. The individual officer at Scott Cash that makes that lending decision also is responsible for coming to a payment arrangement where there are difficult circumstances. So you still have that one-to-one relationship with the customer, the almost old-fashioned bank manager approach, I think you would say. And similarly, there are other tools in our kit to resolve those types of situations. So we're part of the eligible lender deduction scheme, which allows individuals to make minimum payments from their benefits. So I think it's $370 a week, and that helps the individual manage their money to get back on their feet. We'll look at freezing interest and those types of approaches as well. But it's about working with the customer to find a resolution. We work with very vulnerable groups, and we understand that changes in circumstances can happen all the time.
Thank you very much.
One small
Yes,
point.
quickly, Jeremy.
Very quickly, the credit rating you referred to. One of the tragedies is that people who do borrow through CDFIs, and I think through credit unions as well, do not get the full recognition when they borrow and repay in good order. The credit rating is not reflecting that. Credit rating agencies should be required to give proper due credit to those that borrow and repay, even if it's not from a bank but from another institution.
Good, thank you. I'm afraid we're running out of time, but I'll take one last question. Then I'm going to ask the Reverend John Chalmers to sum up. And finally, Angus Hogg, the chair of Carnegie UK, will wrap up the evening. But our last question, please.
My name is Graham Miller, a past chairman of the Scottish Consumer Council, or one of the past chairmen of the Scottish Consumer Council. I think the report that's been produced by Carnegie is very good in the context of where we are. But one of the things I worry about is that the big banks, the clearing banks, are actually giving money to all those short-term lenders. They are making money on the back of the grief that some people have of having to have short-term loans. And the people that have short-term loans, who religiously, and Jeremy actually made that point just earlier there, who religiously pay that money back in the time that's required, are actually paying much higher interest rates to compensate and accommodate those who are not paying it back. And there seems to be a kind of injustice in that. And I do wonder whether clearing banks, who will be making a very good margin compared to what they would normally make from people who have got money, I just wonder where their social responsibility lies in terms of them doing an awful lot more than they could do to actually help that scenario. So it's, you're in a kind of time warp where the people that borrow money short term and pay it back in line with the credit terms are actually subsidising those who cannot, I thought.
Sorry, sure.
Do you want to respond to that, Stephen, or
It's a bit
do
like...
you lend money to Wonga?
No, we don't. And maybe there's other banks here who could answer that for you. So I can't answer that. It is a bit like the classic debate about paying for your current account, isn't it? We all like a free current account, but the people who are subsidising your free current account are the people who don't manage their debt very well. So there are injustices like that in the system, and that's one of the reasons why we think credit accounts shouldn't necessarily be free. There should be a complete review of portability and charging.
Good. I'm going now to call on the Reverend John Chalmers, who's the man charged with taking this issue forward, just to sum up this evening's discussion. John.
Thank you. Thank you. I was with the Archbishop of Canterbury the day that we launched the Church's Mutual Credit Union, and the Church had as much difficulty setting its credit union up and meeting all of the hurdles that were placed in front of it by the FCA. So I know about that. I think my serial number as a saver in the Church's Mutual Credit Union is 002, the Archbishop of Canterbury being 001. You can't win every race. But I was also there the day that the Archbishop of Canterbury discovered that they were invested in Wonga. So the tentacles of the way in which finance and finance houses work reach to places that other drinks cannot reach. And so being clear of all of the pitfalls and dangers that exist in the financial world is very, very difficult indeed. And that is why I think sometimes we have to focus in on what we can fix and what we can see and what we can do something about. Now, I've taken on a few challenges in my life before this one, but very few challenges for which I am less qualified. Some of you and some others outside of here must be thinking, what does Chalmers know about finance, that he should be leading or chairing an action group that's going to take forward the issues that are set out in this report? Well, I'm not taking this on because I know anything or nothing about finance. I'm taking this on because when I see an injustice, I think I can both recognize what that looks like, and I think I can recognize how we might just together be able to do something about those injustices. And I see an injustice here, and I see the way in which Carnegie has helped us to articulate that in a realistic way. And I don't think we could have been better served than we have been tonight by a panel who have been able to describe for us what's just not simple about this. That it's a complex report, it has to be read thoroughly, and you have to drill down and you have to swallow at the end of it some pretty unpalatable truths. Because if it was just rhetoric-centred, as Sarah suggested, then we would be outraged and we would simply say what the Archbishop of Canterbury said: we need to put Wonga out of business. And that's not how it works. And Neil Alexander has described it perfectly for us tonight, that we have to accept that what affordable means is not what the chattering classes think is affordable, but it's what the customer who needs the service understands as affordable. And those people who are determined to try and carry that message to politicians and the other agencies and the general public risk making themselves unpopular, because it's not what people want to hear. But that's what the Carnegie report has placed in front of us, some unsavoury truth, if you like, that we have to factor in if we're going to do something sensible about making affordable credit, affordable according to the customer needs, available on a wider scale than is currently available through the existing CDFIs and credit unions. And where I come into this, as I see it, is as the person who can bring people together around the table. It's not to bring financial expertise to it. This room is full of that. And there are those that I will invite around the table with others from the variety of agencies, from the Scottish Government, local authorities, financial agencies, citizens' advice, and many others that I will want to bring around the table to grow this circle, to grow this, what did you call it, Douglas, a mega infrastructure that's needed in order to be able to deliver this at the kind of scale that truly begins to compete. I just want to thank all of the people tonight who have helped us, I think, in this room to understand the issues at greater depth. And I would simply ask them to stay with us in this journey, and for you to stay with us too in the journey if you're called upon by someone like me or Douglas or Martin who's trying to drive this forward, to continue to give us your insights and to put us in touch with the kind of partnerships that can, in fact, grow this to the point of real change in Scotland, and that could make us in Scotland an exemplar for the rest of the United Kingdom and far beyond. I only know 3 jokes, but I'm going to tell you them. How many psychologists does it take to change a light bulb? Well, the answer is 1, but the light bulb really has to want to change. And then there's how many country and western singers does it take to change a light bulb? And the answer is 2, 1 to change the light bulb and 1 to sing about the old one, which is so much better than the new one. And the last one is how many task groups and committees and councils and boards and parliaments does it take to change a light bulb? And the answer, of course, is change. What's that? And what we've described at the end of this report is an action group, not a talking shop. An action group to try to bring about change. And that's the commitment that I want to bring to this. Thank you.
Well, ladies and gentlemen, you have just very clearly had demonstrated to you why we wanted John Chalmers to lead the group going forward. And this process and journey that we have been on, as was spoken about earlier, was in fact started by John Chalmers in a visit to Andrew Carnegie House some little time back with his colleague Lorna Hood, who was the then moderator. And amongst many social issues that we discussed that day, this particular issue came up. And it was decided rightly that we would take that forward. And I'm really pleased that we have got to the point that we have now got to, and that we continue on the journey with the expert group or working group to try and bring this never to a conclusion, but to a point where we're affecting real change. So we owe John Chalmers a great deal of debt in all of this, and he's right in this up to his neck in a way that he, I think now, only fully appreciates. But he's the very man for the job. Ladies and gentlemen, my job tonight is a simple one, is to say thank you to a number of people, and first of all to Ray for chairing this discussion group tonight and to organising the event for us, and indeed his staff who have helped in that, and to our panellists who have contributed in a way that really has helped considerably in developing the points and so on that have been brought out in that report, and to thank also the staff at the Carnegie House in the form of Jenny Peachy and indeed Douglas himself. And they are the two people who have worked tremendously hard over many, many months in bringing all this together, and so I personally would like to thank them. And to thank you for coming along tonight and listening to this, and we hope that you will stay with us on this journey, and when you have points to make or contributions to make, we do want to hear from you. And as payment in kind for that, I would now like to invite you to have a drink with us outside, and the conversation can continue, and we can hear what you have to say. So thank you to all of you for being with us tonight and for making this such a successful event. Thank you very much.